I hope you are enjoying your lunch. And I don't mean to interrupt that, but there are some people we'd like to recognize for some of their efforts over the last year and some awards that we have to make in regards to scholarship. So I'd like to take a few moments to recognize our GIS scholarship recipients. We have 5 college scholarship winners to announce this year. These winners were chosen by their schools. When I read these winners' names, I'd like you to come up so we can give you, get a picture of you and also let the whole crowd here honor you for your achievements. The first scholarship winner is Kayla Johannes of Iowa State University. Congratulations to you. If you could just stand behind. Thank you. Thank you, Kayla. The second winner is Matthew Stefani, also of Iowa State University. Congratulations. Thank you. The third winner is Shayla Carey of Drake University. Shayla. Congratulations to you as well. The next winner is Adam Chloe of Drake University. Adam. And our last scholarship winner is Kokan Nguyen of Drake University. Congratulations. Yeah, let's get a group picture. Here, come on in there. Come on in here behind the podium. Congratulations to all of you.
Thank you.
Well done. I'd also like to honor some real high-achieving students that have worked really hard with helping with the symposium this year. Garrett and Jesse, would you please join me to be recognized? Garrett Lohner is an Apex associate who's been working closely with our planning committee for months leading up to the symposium. And Jesse Hunt is an Apex instructor who leads a group of more than 20 students with an interest in finance and insurance. Are there any other Apex students in the crowd today? And if so, could you please stand? In fact, come on, oh, there you are, right over here. Congratulations. Waukee High School's Aspiring Professional Experience Program, APEX for short, develops highly skilled, adaptable, global innovators and leaders by bringing real-world experiences like the symposium to these young adults. I want to thank all of you for your hard work. On behalf of the symposium, Garrett, I'd like you to receive a certificate as well as Jesse Hunt on behalf of the high school. Thank you, sir. Service. If you get a chance, for those of you in attendance, if you have an opportunity to visit with some of the high school individuals that are here, these young adults, that would really enhance their experience. So please reach out and speak to them. Thank you very much. It's now my pleasure to introduce our lunch keynote speaker. We all know that insurance can help speed up an economic recovery when disaster strikes. What if the disaster is due to climate change? Dr. Maryam Golnaraghi is tackling a topic which draws a wide range, sorry about that, draws a wide range of views, but it is a subject that insurers want to know more about and understand as we assess the risks that are around us. So please help me welcome Dr. Maryam Golnaraghi from the Geneva Association. Welcome to the stage.
Okay. Well, good afternoon to all of you, and thank you very much to the organizers for inviting me to this forum. I told Ashley, listen, this is a pretty dry topic. I'm going to give the participants indigestion. I mean, is this really appropriate for a lunchtime speech? But so be it. I try to make it interesting. So let's start. Let me tell you a little bit about my background so that you see how the comments I'm going to make to you today, where does this come from? I am, by training, a climate ocean modeler from the network of Harvard and MIT. But I was one of those rebels who didn't want to go back to academia to teach. So I went to the business school, and with the help of the dean of business school, this was in 1990s, I went in front of about 70 executives in a variety of industries, of which several were from insurance and reinsurance companies in US and internationally. And I talked about climate risk, not climate change, climate risk that's upon your businesses from the next month to the next season, to the next years, to the next decades. And at that time, believe it or not, the forward thinkers in this whole set of entities that I talked to were about 15 CEOs or CROs or senior advisors in the insurance sector, because you guys manage those physical risks. And when the 1998 El Nino happened, a few of them called me and said, what were you talking about? Now, can we start talking more seriously about this? And that led to setting up a research and analytics company in Boston, based in Boston. And that was also the birth of risk modeling, cat risk modeling in the industry. So I had the privilege of working with the cat risk modelers and a lot of companies to see how you can best leverage data information and intelligence that's coming out of the field of weather and climate to better model your risks. So that's where my path started. After 8 years of doing that, I was nominated by the US government to go to United Nations and build a program that brought the latest in science and technology with risk modeling analytics and help governments build the capacities that you have started building in your industry for purposes of more risk-informed decision-making that touches on preventive measures against disasters, preparedness measures and early warnings, and ultimately expansion of risk transfer. About 4 years ago, there was a mutiny in my household. My kids said, Mommy, enough. We want to go back to North America. So I had to give up my UN position. I moved back here, but I accepted a position at an international think tank, the Geneva Association, and this is where my talk begins. What I want to tell you a little bit about what is the Geneva Association, and then go through a debate around defining climate risk. This is not a scientific talk. If you're going to expect that I try to justify to you whether climate change exists or not, that's not the purpose of my talk. What the purpose of my talk is to show you some of the latest policy, regulatory, financial, and market developments related to climate change that points to two facts. One, transitioning to a low carbon economy over the next 2-3 decades is inevitable. And two, climate risk is no longer a sustainability and social responsibility issue, but will become a core business issue. I listened to the CRO, the Chief Risk Officers panel this morning, and I would like to maybe challenge and say, be prepared, climate risk management will become part of a core business issue, and I hope I can convince you to that point. with my point number 4. What does it mean for your industry? And then the key strategic issues and policy research that we are working on to help the industry to really strategically position itself and be able to, serve as a solution as opposed to think that it is part of the problem. So what is Geneva Association? Geneva Association is an insurance, economics, and risk management think tank. It was established in 1973 by CEOs of the insurance and reinsurance industry and former Prime Minister of France. It deals with highly strategic issues in insurance, risk management, and economics, and essentially conducts policy-based research and facilitates high-level dialogue, engaging CEOs and C-level suite with stakeholders in the government, from ministers to regulators and others, around key issues that impacts the industry. Now, sort of our stakeholders beyond the insurance industry are governments, central banks, international organizations such as IAIS, Financial Stability Board, G20 and G7 platforms, World Bank, OECD, among others. And it's a unique platform of international, of CEOs and the other C-level suite from large insurance and reinsurance companies globally. Our membership currently, we have a statutory membership of 90 CEOs, so our members are CEOs. The ones that we interact with are at the CEO level. Of that membership, around 50% is in Europe, 20% US, Canada, 20% Asia, Australia, and 10% Latin America and Bermuda. And we are now working to increase our membership in North America and in Asia and Australia. So just to give you a feel for who is a member, this is our board of directors, essentially are the group CEOs from the largest insurers and reinsurers, both on life and non-life. I think you would be familiar with all these faces. I have the privilege of working directly with these CEOs to really think about the field of extreme events, which goes beyond climate. It goes into geological and other hazards and climate change, what strategies, approaches, actions the industry can take as a collective to ensure that its value chain is best realized in this domain. So we think about this in a very solution-oriented approach as opposed to, oh, what are the regulatory problems or whatever. What can we bring to the table as an industry? Now, Geneva Association has 4 priority topics. One is technology and cyber. Second one is extreme event and climate change. Climate risks, actually not climate risk. Third one is health and aging. And last one is financial instability and regulatory regimes. So I joined the Geneva Association about 2 years ago to help the CEOs and the industry to really formulate a sort of a plan of action in this field that would really help strengthen the footprint of the industry in this domain. Now, what is our approach? In 2015, we issued a climate statement that was signed by 68 CEOs of the industry. And I urge you to look at it. By the way, I have asked the organizers to avail my slides. And I have put a lot of links to things, so you don't need to take notes. Please make this available to everyone. I urge you to look at this statement, because through this statement, we pointed to the industry's value chain and various skills and expertise that industry can bring to this dialogue. And talking to our customers, talking to the regulators, and talking to entities that are really working in this area. Now, building on that statement, now we need to come up with concrete actions from the membership of Geneva Association. So how do we achieve that? We achieved that by, number one, doing underpinning research, and I will share some of the findings of that research with you today. Then having very open and extensive dialogues with the CEOs, and then with high-level stakeholders from governments, regulators, intergovernmental organizations, and others, and then facilitate dialogues among them through various forums, and reach to strategic priorities and themes that industry, as represented by our membership, would be willing to take forward. And then we do our policy research on those themes and influencing around policy and regulatory issues by bringing our community of C-level executives together with our stakeholders, and also facilitating public-private partnerships that can further advance the issues. So that's about Geneva Association. And at the end of the talk, I have some references to some of the work that we've done that you can reach out and look into more deeply if you're interested. So let me first, the next point is, let's define climate risk. And you may recall what I call a historical talk given by Mark Carney, chairman of the Financial Stability Board and governor of Bank of England, at a forum on 29th of September at Lloyd's of London, where he talked about the tragedy of horizons and climate change being that, and he particularly pointed out to 3 types of risk that have significant implications, financial and economic implications linked to climate change. First one being physical risks. Risks related to impacts of weather and climate-related events, such as floods, storms, that impacts property, infrastructure, supply chains, and trade. The second one that he highlighted are liability risks, impacts arising from parties who suffer a loss and damage and ultimately seek compensation from other parties that they find responsible. And in that regards, what he highlighted is that these cases could happen in the future, and particularly if there is liability cover, insurance industry could get hit by that. Third type of risk is transition risks. Impacts and financial risks arising from processes of adjustments towards a low-carbon economy, and very much so linked particularly to the investment strategies of this industry and potential for stranded assets. That could be linked to climate policies that put a price on carbon, sectoral policies that may make certain sources that are part of the investment obsolete in energy and others. So we need to be mindful of that. And then I add one more risk, which is reputational risk, that you can read more about. And those are reputational risks when a company's brand is associated with climate-related damages, and that could have some potential impacts on the companies. Now, I won't go into all these risks, but I want to take the first one, physical risk, which is your bread and butter, particularly if you're underwriting, various kind of, in your property and casualty business, various kind of products and services. But I will give you the global view. When you look globally, you see that 91% of events that happens around the world leading to significant financial damage are weather-related events, with 38% in Asia, 21% in North America. Now, when you look at the prominence of these, when you look at particularly on financial damages, most of the financial damages takes place in developed nations because, by nature of the fact that assets have been concentrated there, and then in terms of loss of life, primarily it's in developing countries. And very importantly, and that's what I was saying, 79% of economic losses were caused by weather-related extremes, and 90% of insured losses were caused by weather-related extremes when you look globally, with North America being the prominent continent to realize those. So on average, when you look around the world, however, you see that there is quite a deep insurance protection gap. something on average around 70%, with around 50% in developed nations and around 90 to 95% in developing nations. So quite a gap when it comes. And the way insurance industry realizes this, it's an opportunity for expansion of insurance, because many empirical studies are showing that countries that have a deep penetration of insurance recover a lot faster and a lot more effectively from those disasters. And these are some of the issues that are not understood by the governments, by the ministries of finance, because they are not trained in insurance. And some of these issues are part of what we are trying to reach out in the world. Now, when you look at the physical risk, I won't take you through the causes of it when it comes to hazards, but let's look at exposures and vulnerabilities. This increasing rise in economic risks associated with weather not only is linked to changing characteristics of hazards, but very importantly, to changing characteristics of exposures and vulnerabilities. Growing population, development patterns, concentration of people, assets in high-risk regions, fast urbanization, complex dependencies of supply chain and trade patterns. Let's think about the 2011 floods in Thailand, which had quite significant impact on some of our electronics and companies in the United States, because a lot of the parts were produced in that part of the world that was not anticipated. What I'm trying to say is only now people, governments, companies are starting to look at these interdependencies, not from just the peril point of view, but from interdependencies of our supply chains and trade patterns. Cascading failure effects of infrastructure. I was part of a team that worked with government of Japan during the earthquake, tsunami, and nuclear accident. Well, you would say, what's that to do with climate change? First of all, the link there is rising sea levels are exacerbating storm surges and tsunami effects. But let's not worry about that part. Let's worry about the part that we saw a very good examples of of failures of infrastructure that really impacted that society. Interlinkages of natural and man-made catastrophes, and then destruction of natural infrastructure as buffers. Increasingly studies, one study by Lloyd's in case of Sandy, are indicating that investments in marshes and wetlands and others significantly reduces the impacts of disasters. So there's a whole area around linking reinvestment in natural infrastructure as a way of reducing the risks. Now, in the next chunk of my talk, which is about latest developments, I'm going to point out to some international policy, national policy, subnational policy and regulatory developments, as well as developments on the financial and markets fronts that points to two messages. Number one, we will transition to low carbon economy, even though the pathways and how long it would take is still not 100% clear. And secondly, is that any publicly traded company eventually will be accountable to systematically report its climate risk as part of these annual statements. I heard a very good comment this morning during the CRO event around how regulations can really compromise innovation, and I want to point to that because there is a threat of that here, and I want to sort of bring that point out. So let's go through what I call the 8 key drivers of why we at our think tank and working with our CEOs have concluded these. The first one is what you've heard about the climate change Paris agreements. Now, for years, people said, that's UN blah, blah, blah. Governments go to these forums, talk, but not much has happened. I want to challenge that what happened in Paris in 2015 was a little bit different, in the sense that for the first time, you saw a very prominent step from the governments to actually agree to this framework. And there is a reason for that. Before 2015, the whole framework of international policy agreements was we come up with one policy and we impose it on all countries. Of course, when you look at the sovereign nations, nobody wants anything to be imposed on them from top down. So there was a lot of these agreements between developed and developing countries. The executive director of UNFCCC, Christiana Figueres, thought about a whole different idea, that let's put the responsibility into governments and let them come with their plans, and then we look at the aggregate and see where we are in terms of our aim to stay at average 2 degrees temperature. And that's the process they started 3 years prior to 2015. And ultimately, they reached an agreement. So that's the difference. They really put the responsibility on the governments to come up with a plan that would meet the requirements. And what Paris Agreement does is it provides timelines and priorities of action related to mitigation of GHG and reduction of emissions. It will go into force in 2020 with nations obligated to provide their plans, and I will get back to that. And then every 5 years, they have to up that. And every 3 years, they got to report where they are with the reduction. 2050 is the target for decarbonization. So what you see right now is many governments are submitting their plans. So far, Canada, United States, even though I have to say that was during Obama administration, we have to see how it evolves in the US. Mexico, Germany, they have started to submit their plans, and the deadline is 2018. One thing that we see is not happening, which is a challenge, is that consultation with subnational governments, state governments and local governments, and the private sector is missing in development of these plans. And that's going to be a challenge. Okay, so you can have a great plan, but if you're not consulting with those that actually will implement it, which will be the industry, across sectors, energy, agriculture, transport, water, insurance, and others, and the state and local governments, so we will see how that debate will come up. What the dangers of this is for anybody that comes out of the private sector is that because now governments have their own way of coming up with their plans, budgeting, and regulatory frameworks, it could create fragmentation. So, and you see that already, that local governments, provincial governments, or state governments, and national governments are coming up with their own policies, with their own carbon pricing, with their own plans as to how to decarbonize their energy supplies and energy consumptions and so on. So the one issue here is potential fragmentation in the policy and regulatory regimes that could make this implementation challenging in reality. We have to see how that evolves. Now let's go down to national and subnational policies, and I want to show you some of the latest developments. Who is taking action? Very recently, Canada submitted its 2017 budget. It has dedicated around $9 billion in its 2017 budget in that transitioning to low carbon economy, and the whole issues around these issues. Countries are starting to really think about carbon pricing. I've listed them. Various reporting requirements at different levels of the government, from French Energy Transition Law, Article 173, to, in the United States, you had the California Commissioner requesting the insurance industry to report on its investments in low carbon, very fragmented at this point. And I can say that that could be a threat. That could create a risk if governments and various bodies don't get their act together. Mandatory regulations impacting banks, and then variety of initiatives at subnational. So things are starting to happen. They're starting to reflect in policies, regulations, and budgeting and various mechanisms. Keep an eye for that, especially if your business goes beyond your local jurisdictions. Now, on the physical risks front, this is something that I would see it as an opportunity for the industry. when you look at many countries, you see that issue of physical risk management of extreme events has been more of a humanitarian issue. Governments are not investing heavily into understanding those risks and developing preventive measures to reduce those risks, and they don't even look into risk financing and insurance mechanisms. I'm, again, telling you the international story, and I can almost tell you country by country where the status is. But the big comment that I want to make is there has been an international developments with countries around the table at the level of ministers of finance, ministers of disaster risk management, to start thinking more comprehensively about managing of this risk. And I want to point out that area of risk financing and risk transfer is rising up to government's priority list. And that is a very important point here. The second thing that I want to point to you is the innovation that came out of this industry in the 1990s, following the failure of some of our companies from the major hurricanes in the Atlantic, namely the cat risk modeling, is starting to penetrate into governments in variety of forms with recognition of insurance industry as the innovator. So some of those things are taking place, and I would be very happy to talk to you about that, because in fact I'm leading one of these international initiatives and happy to tell you more about how is that happening. Now, fourth element, Financial Stability Board. As I mentioned to you, Mark Carney gave his historical talk around these issues with the point that he sees climate risk as one of the big risks facing our financial systems and our economies. And in 2015, he established a task force, which is the Task Force on Climate-Related Financial Disclosures. It's chaired by former Mayor Bloomberg, and 32 members from the financial sector, from rating agencies, and from a variety of companies to look at new ways to standardize reporting of financial risk on annual reports. So that recommendation is out and is being discussed at the G20 forum this year, and it's anticipated that this reporting will hopefully take over this highly fragmented reporting and compliances that has emerged over the years out of the sustainability and social responsibility forums through UN, through NGOs and other mechanisms. Our companies are spending more of their time complying than actually doing their work. So the idea is, how can we better standardize so that we can have more solid information for the investors and others to see how this is happening in the private sector. So the report that has come out provides guidelines as to how climate risk around those three elements that I talked to you, physical, liability, and transition, is going to be reflected at the governance level through the boards and the C-level suite, at the strategy level, risk management and operational level, and metrics and targets. So they have even gone far enough to look at different sectors and sort of determine these requirements for energy, agriculture, other sectors that are at risk, also for insurance, and they have provided significant amount of sort of guidance on that. So it is intended that this is going to be voluntary, but I'm taking my hat off as an official and as an expert that has worked in this area. Before you know it, it's going to become mandatory. Every analyst is going to require that, and probably is going to the regulations are going to kick in with that. So let's wait and see, but keep your eye on that one. So I would say that this initiative has really transformed the issue of climate change risk from a sustainability and social responsibility issue to one that is a core business issue. And we will see how this, and by the way, this task force has gotten a 1-year additional mandate from G20 to actually look into implementation details. Other developments, rating agencies. As you may have seen, Standard & Poor's, Moody's, Bloomberg, they all have developed a very strong climate research bodies and teams. And they are right now developing various assessment tools to be able to analyze the financial reports and annual reports more systematically. This morning, they just issued, Standard & Poor's issued what's called a green assessment tool to be able to rate companies according to how they are doing in working in this area. So these guys are getting ready. And if you really dig in, you'll see that over the last 3-4 years, there have been 60 companies that have been downgraded because of lack of capacity in addressing climate risk. There are many references here that are in my report, so if you're interested in digging in, you can find that. Increasing shareholder awareness, changing sentiments towards carbon-intensive industries, and a lot of litigation cases in particularly US, Australia, and EU. Increasing investor interest, alignment towards low carbon. You see companies such as BlackRock, Goldman Sachs, and various investor coalitions are heavily pushing on these areas. And then actions at company and sector levels. Increasingly, I'm witnessing companies that are starting to discuss these issues at the board level, C-level suite, and actually are trying to see how they can penetrate that into their boards, working groups, from audit to risk management and others. So these are getting traction. Increasingly, sustainability and social responsibility teams are coming under the CRO, and sort of industry, company, multi-division teams are put together to start looking at some of these issues more systematically. And from a sectoral level, I think when you look at the membership of the GA, the CEOs are quite concerned to really take a positive approach and educate and sort of determine what can be done at an industry level to help with some of these challenges, to really help the world in that transitioning from an insurance industry's perspective. Now, what does it mean for the industry? So, of course, on the what's called adaptation, climate risk management, or resilience, there are all these lingos that are sort of going around. From that side, what is the value chain of our industry is share risk knowledge and risk pricing. I can tell you that insurance industry internationally is very active to ensure that risk modeling methodologies are sort of transported to particularly the public sector. This is absolutely crucial in terms of risk reduction, insurability, and risk pricing. Those concepts are not understood by the governments. To share research and knowledge in preventive measures, innovation in risk transfer products and services, massive amount of innovation that has gone beyond just commercial and residential into helping protect government budgets in anticipation and post-disasters. So a lot of products have been developed, parametric insurance, particularly where indemnity insurance won't work because of lack of data. Faster and more efficient claim settlements. So after a disaster, it's being discussed that insurance industry probably have more potential to get the funding to the people than the government themselves. And that whole issue of disaster funds that governments manage, and most of those programs are actually are running out of cash. Can there be solutions and discussions with the industry in terms of managing and better positioning of post-disaster funding and solutions? And then support for development of sound risk transfer programs through close cooperation with governments. I actually have published a paper around the very many failing national insurance programs around the world that are government-driven with no discussion with the private sector and not leveraging of market-based insurance. So there is a whole movement, and I will show you through what channels, to start bringing ministers of finance and others together with this industry to start thinking more collectively about sustainable insurance programs. Now, on that front, we did a major analysis, and the reference is available, in looking at why this insurance gap, overall challenges, and I'm getting out of time, I have only 5 minutes. So high-income countries, what are some of the major issues, and then mid and low-income countries. This was in anticipation of starting that dialogue with the governments, because insurance alone is not the silver bullet, but it's a very critical tool, but it requires enabling environments to help it prosper and evolve and penetrate into a country. So that's the basis of the discussions that we are facilitating with some of the government officials around what are some of those requirements. And also the industry is engaging with a whole sort of stakeholder landscape to start working with the governments at a much more proactive and productive level in terms of the concept of insurance and insurability and what the industry can do. I don't expect you to be able to read this, but all I can say is expansion of insurance beyond where we are today was very slow until around 2005, where all these initiatives that I've talked to you started, and the industry starting to work much more systematically through the right channels with the government. So from 2005, there is significant expansion of insurance and insurance solutions in developed and developing countries, and there is a paper on that that you can look at what has done that. My last points are around the investment side of the insurance, because too many times, and I'm a very dear friend of Christiana Figueres, who was the UN executive director in UNFCCC, and I saw her and Ban Ki-moon going around and trashing this industry around, oh, why aren't you investing in low carbon, and if insurance industry, it's a very simplistic almost way of thinking about the role of this industry. So that motivated a study within, and in fact I brought Christina and Ban Ki-moon to our forum so that they can get educated about how insurance works, and the drivers of insurance business model, the fiduciary responsibility of the insurers, so that we can start thinking positively about how insurance as a second largest institutional investor can engage in these investments. So what that has done, it has motivated a major study that we are interviewing chief investment officers, chief risk officers, and chief actuaries of our 90 members. Total asset under management of our members is around 20 trillion, so that's a significant part of this industry. And our goal is to help the world better understand fiduciary responsibilities of this industry, drivers of investment strategies, the ALM model, and how the two sides of the business have to work together, the political risks for any investors in investing at scale, lack of sufficient green investment opportunities. People are asking you to invest, but where are the investment opportunities that meet your fiduciary and financial requirements? A need for data and transparency, and very importantly, capital requirements, regulations and capital regimes that disables insurance industry to invest long term. The world needs to understand that. And then I think through a better collaboration of governments, regulators, and industry, one can work ways in which the industry can start thinking around those issues. On the opportunity side, we see a lot of innovation in product development to encourage behavioral change towards low carbon. So just to make this short, our goal is to go out there and really bring the different elements from the markets, from the governments, from regulators, together with the industry to find solutions, as opposed to fragmented approaches that is not very productive. So with that, we have focused our research around two pillars: transitioning to low carbon, role of insurance industry in transitioning to a low carbon economy from both liability side and investment side, which is this report that we will publish end of the year based on interviews to really try to reflect on insurance industry's perspective. And then on the resilience side, I'm leading a major project on innovating risk modeling to innovate risk management and risk transfer with two purposes. One, how can we transfer innovation and experiences from industry to the public sector? Two, priorities for innovating risk modeling by really bringing science and technology from weather and climate to big data, AI, and others into really enhancing our risk models and make them more predictive. I think one of the CROs was talking about how our risk models are backward looking. Pathways to more effective public-private partnerships. We are doing a major case study around Australia, UK, Germany, Canada, and Japan on flood risk management and risk transfer solutions, and particularly focusing on how government and the industry work together. And then, very importantly, next year we will launch a study on opportunities for investing and resilience in critical infrastructure, which seems to be one of the highest priorities of many governments. Just the takeaway messages, they are now well-defined risks in terms of impacts on economic and financial resilience, a number of policy, regulatory, financial, and market-based development that's pointing that we will transition to a low-carbon economy, although the pathways are yet to be determined and could be quite rocky. The importance of integrating climate risk as an integral part of core business in all sectors, including insurance. Insurance industry could play a critical role. We see it as a solution, as part of the solution, not as a full solution, part of this solution. And but there are many challenges in terms of policy, regulatory, capital, and market-based issues, and reaching an industry-level common vision and prioritization and engagement with other stakeholders. No entity can solve these problems alone. And I think we have to break down discipline barriers and institutional barriers and work across. And then I showed you the Geneva Association's research. The last slide just tells you about our reports. I won't go through them, but again, please make the slides available and you can see some of the work we've done and some of the reports that we are putting forward. Thank you very much for your time. My pleasure. Thank you.
Well, thank you very much, Maryam. There's a lot to cover in this area, clearly, and appreciate your breaking it down for us. We are going to reconvene upstairs for the GIA demo days, and that will start in 10 minutes. So 12:45, we'll see everybody up there. Thank you.